Hey everyone, welcome back to the Market Chat. My name is Richard Moglen. Joining us today is Ryan Worch of Worch Capital Management, and we've got a lot to talk about, including stock selection, his background, and getting into some post-analysis at the end of the interview. So Ryan, thank you so much for taking the time out of your day and joining us with this interview.
Great. Thanks for having me. It was interesting to first meet you, knowing that you're a local guy.
Right.
It's really cool having that connection with kind of where we grew up, University of Maryland. So I'm excited to do this.
Awesome. I always like to hear about people's backgrounds and kind of get started that way and talk about books, early mistakes you made with trading. So can you tell us a little bit about how you got started with the industry and also how you got first interested in the stock market?
Well, we could probably spend a whole podcast just on mistakes.
Yeah.
Certainly. So, I've been interested in stocks and the stock market from just way back when. I had an interest as a little kid, quite frankly, sitting with my granddad over holidays, going through. He had a little black book he kept of all the stocks he owned, and it always interested me at a young age. And as I think second or third grader, I asked for shares of Disney for my birthday, which I don't know how many 10-year-olds ask 9-year-olds ask for that for the birthday. So I always had this interest in the market, and it was probably, again, groomed from a young age to see with my grandfather, just having that interest and curiosity towards it. I ended up majoring in finance in college at Virginia Tech. But as most 21-year-olds coming out of college, you have no idea really what you want to do. And ultimately, I always say you do things to figure out what you don't want to do. And I think that leads you ultimately to your career path. So right out of college, I graduated Virginia Tech May of 1999, and I ended up going to work for my father, my brother. They ran a electrical subcontracting company, and they wanted me to come in and do a little bit more of the business side, learn the business. I had worked a couple summers for them, doing some manual labor, pulling some wire, doing that stuff, learning a little bit of the trade. But what I really quickly learned is I just did not like the electrical business. Mm-hmm. And I went and talked to my dad, and he gave me his blessing and said, you got to do what makes you happy. So I have another brother who was in the financial business, and he started introducing me to some people, and I just went out and started interviewing all different types of things. Mm-hmm. I interviewed. This was again in the late '90s, and telecom was huge. Clearly, the stock market was hot with the tech bubble towards its end. I didn't know that at the time. So that was another industry that was big. So I kind of interviewed all over, and I fell into a job with a local broker dealer. You'd be familiar up at Gaithersburg, Maryland. I basically my brother had introduced me to a couple brokers at the time at a small broker dealer. They were so busy managing their own money because they were making just tremendous amounts of money trading tech stocks.
Right.
At that time, they were trading more small cap, but these things were going up 20, 30, 40% in a day sometimes. So they needed someone to come in and help with their customers. They were institutional and retail brokers. And I really just pestered them for months on end until they finally, I think, threw in the towel and just gave me a job because they were so sick of me calling. So I always had certainly that persistence and motivation.
Right.
So they hired me, I believe it was towards the end of '99. And again, the tech swing was just right at its pinnacle.
Right.
I ended up getting licensed Series 7, that whole 9 yards with them. Shortly after I got hired at their broker dealer, they ended up leaving about a year after and starting their own firm, running just family money that they had made throughout their time, the last probably 15 years, trading their own capital. So they set up their own family office, and I went and worked directly for them for the next 6 years. And that's how I got my start in the business. my evolution into running my own fund and manage my own money is a whole nother story. And I think a lot of your listeners will gravitate toward that and kind of understand how ultimately I got into doing what I'm doing now.
Hmm.
Uh,
And yeah, and at that firm when you're first learning, were there any books that they gave you? How did you get first introduced to the kind of can slim model of stock selection and trading?
so it's interesting because they basically just threw me in. They really at that time were so busy. They just needed someone to handle customer orders. And I was kind of just doing everything.
Right.
I came in just wet behind theirs. I didn't know anything.
Hmm.
We had a Bloomberg Terminal, we had the Wall Street Journal, and one of the other papers we had was Investor Business Daily.
Hmm.
So I spent a lot of time the first few months just kind of getting the lay of the land. I studying for my Series 7, doing that stuff, and kind of just doing anything to help them alleviate the pressure with their customers. So what ultimately happened in that first year is the tech market just collapsed.
Right.
With it, obviously peaking in March of 2000, and then we had just that long 3-year bear market. But I would say from probably middle of 2000 to the end of 2000, or maybe into 2001, there were some just devastating moves on the downside.
Yeah.
And what I took from that is I saw my bosses and a couple of the other big traders at the firm, just the toll it took on them. Now, again, these were really smart guys. They made a lot of money on the upside, but when it swings the other way, and especially they were more micro and small cap managers, I saw the toll it took that they weren't getting out of position because they believed in them.
Right.
These guys were deep fundamental analysts. They were CPAs by training. So they wrote a lot of positions down, and psychologically and emotionally, it takes a toll. And I don't forget. I'll never forget that. I mean, they would lose weight. They wouldn't eat. They were irritable at times, and I get it. When you're losing money, it's challenging, and you really only can learn that through experience. So I kind of started trading my own account when I first got there. I was living at home. I was trying to save some money. I wasn't making a lot. I think they hired me for $25,000, but I just kind of want to get a foot in the door,
Right.
and that was my opportunity. So I was saving as much as I can. I opened up a Scottrade account, $500. Every paycheck, I put a couple $100 in it, and my whole operation and my strategy, my trading plan was to buy what they told me. Now, that's a plan for failure. At that time, I didn't know it. These guys are smart, and I'm just kind of riding their coattails. So I was having some success because I started in early 2000, and even though the market peaked in March of 2000, it actually rallied back up towards May, and these were vicious moves.
Yeah.
And you had stocks that were selling off 50% and bouncing 70, 80%. So I actually had some success buying some of their recommendations. Well, it all came crashing down. I'm sure that's not news to your listeners. I'm sure a lot of people have had the same experience. And I want to say the best experience I had was losing money. And luckily at the time, it wasn't a lot of money looking back. However, it was a lot of money to me at the time because it's all the money I'd have. It's all the money I'd saved. We're talking a couple $1,000s. I think I had $5,000 at the time max in that account. And I'll never forget, I bought Nortel Networks, and I bought a lot of it. I was kind of heavily concentrated in names, and I was kind of flipping stuff here and there. Well, Nortel reported earnings, and the stock gapped down, I think 40, 50%. And I basically lost everything that I had made and then some, basically overnight. And that was an eye-opening, awakening experience for me. And I said to myself, I've got to figure out a better way. I can't be responsible for decisions based on other people's opinions.
Right. Right.
So what I did is I really just spent the next few years doing some real research on, how to invest, how to trade. I read everything, from Benjamin Graham, Deep Value, to William O'Neill, were probably at the opposite ends of the spectrum. So I
Right.
think the real things that got me started was the firm at the time had, they got a copy of the Investor Business Daily. And I never heard of it. And I started reading it. Once I started reading it, especially after I went through this period where I had a little bit of success and then I basically lost it all, it just spoke to me. I understood it. It really made sense and fit with my personality. My personality, I didn't like having massive losses. I didn't like trusting, what CEOs were saying, and being a deep fundamental analyst like my bosses were. It was worked for them, but that suited their personality. And I think a huge lesson of this is you ultimately have to find a methodology or a strategy that fits your individual personality. And that's kind of what Cancelim did and Investor Business Daily did for me. It gave me that foundation that I understood and I believed in. And it allowed me to get out of stressful periods. But this wasn't, an overnight experience. I mean, this took years and years and years of just reading just tremendous amounts of research all across the spectrum and trying different things and seeing what worked and what didn't work. And ultimately, that's kind of how I became successful and more confident in my abilities and more consistent in my trading. And listen, I think this business is the hardest business in the world, but it's also one of the most rewarding if you know how to handle it. And it can also be a disaster if you don't understand risk. And I think you have to be extremely, extremely disciplined in trading because, again, the buck stops with you. You can't blame anybody else.
Mm-hmm.
You make the ultimate decision whether to buy or sell something, and you have to live with that. And that's why I love this business, because your P&L is essentially your scoreboard at the end of every day, end of every week, every month, every quarter, every year. You know how poorly or well you did based on your equity curve and your P&L, and that's what I love about it. And I do believe it's the greatest business in the world, while at the same time it's probably the hardest and most challenging thing to do, is to outperform or to have a consistent strategy discipline that you can manage year in and year out with consistent results. And it's not an easy feat by any means. It's crazy how time flies. I've now been doing this for 21 years, which is crazy. But what I also know is that every day is a learning experience. I mean, I learn something new every day. And I think you have to have that curiosity and that certainly an interest, and I would call it a passion, to want to get better and want to constantly learn. Because just when you think you know it all, the market certainly is the most humbling judge for anybody. And again, just when you think you're at the top, it has a real funny way of knocking you off that wall.
100%. And you mentioned there that you have to learn to respect risk. I usually ask this down the line in the interview, but could you define what risk is to you, and also maybe a few tips, guidelines for people to learn how to manage risk who maybe started in the past few years trading?
Yeah, I mean, I think this whole business is really, I'd almost say I'm a risk manager first.
Mm-hmm.
If you don't have, it's like gambling. If you don't have any chips to bet, you're out of the game. Mm-hmm. So I think risk management is where I came at it from. And that's why Investors Business Daily, I believed in so much, because that was that's what they preached and they talked about over and over and over. It's risk manager, risk manager, risk management. And at first, I didn't understand it. And you really don't understand it until you put your own capital at work, quite frankly. So I always say, I'm a risk manager first. Capital preservation is my number one goal. And I've been able to successfully show over multiple market cycles that we can handle it. And we've missed, my firm, my fund has missed every down move since 2007. That includes the financial crisis. That includes the coronavirus panic. People want to say that the market has been in this 10-year bull market. Well, secularly, we have been in a bull market, but there's been 5 stressful periods in that time. Right. Clearly, started in 2008 with the financial crisis, and that was a devastating bear market. But if you preach risk management and you practice it, you could have sidestepped a lot of that 2008 into early 2009. Same with the European debt crisis or the flash crash, 2010, the European debt crisis 2011, the taper tantrum in late 2018, and then the last one. Albeit they were cyclical bears within a secular bull, but they did some real damage to the markets and individual stocks. I mean, right. In the last go around, the markets were down 30% in a month. Individual stocks were down 50, 60%, depending on the industry you're in. So these can have devastating effects. Again, not only on your P&L and your capital, but more importantly, they take emotional and physical toll that people don't see. Especially when you do this for a living and you manage other people's money, it's extremely stressful. And you have to be willing to deal with that. And you have to have a discipline and a strategy to be able to get out of those markets. Now, that's what works for me. Some people are comfortable sitting through drawdowns. I'm not. Mm-hmm. I'd rather get out first, ask questions later. And I don't always get it right. But when there's big waterfall events happen, historically, we've gotten out early enough and we've been able to be in the safety of cash. And I think that's the biggest benefit of risk management. And I think that's what we preach. And we've been able to prove it. And we have, again, 15 years of data now running other people's money that show that, we're able to do that. Again, like I said, we're not perfect. There are times where we certainly, will miss, maybe a 5% move, down move doesn't turn into that 20%. There's certainly plenty of those. But at the end of the day, I think risk management is so critical for so many aspects. Most importantly, again, for me, I've seen people being blown out of this industry because they didn't have any risk management and they lost all of their capital. And that's where I come at it first from a trading and investing standpoint, that if you don't have any chips to play, you can't play the game.
100%. And how do you personally practice risk management with stop losses, position sizing, and also how do you make sure you're staying in tune with the market so you can identify when it might be weakening and those bear markets could possibly happen?
Yeah, I mean, it's such a good question, and it's so intricate. Right. And we could probably bring it to today's market. This has been an extremely challenging market for myself, even though the indices are all up healthy for the year. Mm-hmm. I say there's usually typically 3 defined trends in the market: uptrend, downtrend, and a neutral trend. A neutral trend is, let's call it a sideways choppy trend. Sideways choppy trend is going to be the hardest market for someone like myself who needs a trend in either direction to extract alpha. That, at the end of the day, one of the biggest things for our strategy and methodology is we need a good, healthy uptrend.
Hmm.
And you could say the markets have been in an uptrend this year because, again, they're all up. But if you look at the NASDAQ, a lot of it peaked in early February, especially growth stocks. We use growth stocks as our underlying investments to gain exposure to the market. So we're not just trading the indices, we're trading individual positions. And most of them peaked in February, and a lot of them are still below their 52-week high. So it's been actually a very choppy environment for growth investors. And I speak to a lot of other fund managers that are similar trading styles, and we've all kind of struggled this year. If you just looked at the S&P, you'd say, how could that be? S&P is up, close to 20%. But you have to really look at the underlying stocks that make up the market. So you have to be able to also, I think, adapt to different market environments. Certainly buying a breakout in a choppy trading range is going to be a disaster. So, a lot of what I do is, I feel like the market is one giant puzzle that's never solved, and you're always adapting to different market conditions. I don't know when an uptrend is going to turn into a downtrend, or when an uptrend is going to turn into a choppy chop and slop like we've kind of had over the last 5 months. I don't know when a downtrend is going to turn into an uptrend. We have, some indicators that we use that give us maybe some probabilities on when those inflection points happen, but you never know anything with certainty. So again, I think risk management is what allows us to make our bets and then reduce our downside exposure if those bets don't work. When you talk about how do we use risk management on individual positions, once a position is entered, we enter a stop immediately. So I don't have a hard and fast rule of exactly where every stop is. It's unique to each and individual trade, but it all is encompassed within the risk management framework, which goes into position sizing. There's a lot of different factors that go, the liquidity, the conviction we have in an individual name, the trend of the underlying market, the trend of the underlying position, the fundamentals of the underlying position, where we are in the cycle. There's so many different moving variables, and it's such a dynamic thing that changes daily. So what I may like today, I may hate tomorrow. So you also have to ask people, I think it's all relative to time frame. Everyone's time frame is different. A long-term investor is going to have a much different outlook on an individual stock if it's down 20, 30% than a short-term investor. But a short-term investor, it depends how you define short-term. Some people are day traders, some people are swing traders, some people are position traders. My sweet spot is probably a few weeks to a year. So I'm looking for catching a strong part of a trend within that time frame. And that's, again, what we try and do on a daily basis. We're always looking, but we're always coming at it from a risk standpoint first. How much can we lose on a trade? We never think about, I never go into a trade and say, how much am I going to make?
Right.
I always size it saying, how much can I lose? So each trade, the maximum that I'm willing to bet on any one individual trade is 1% of my total equity. So, historically, what I do, I think one of my strong suits is I keep a tremendous amount of data on my trading. And I know every single trade I've made since the inception of my fund back in 2008. And I know all of my numbers down. So my average loss actually over, 13, 14 years of trading in a fund vehicle is only about 25 basis points. So I'm cutting my losses actually a lot faster.
Right.
even though my maximum is 1%, that's the maximum I'm willing to accept. But most of the time, I'm cutting it faster and quicker than that. So, the question of how long am I in a trade? It's very skewed. My best trades, I'm in the longest.
Right.
And a lot of trades, I'm out very quick because I'm cutting those losses. If a trade doesn't work fairly quickly, I'm out. I'll move on to the next one, or I'll wait until I get another entry. So at the simplest form, I mean, we really just want to ride our winners and cut our losers quickly.
Right.
I'm sure you've heard that the KISS principle, keep it simple, stupid. It's true. I mean, that's at the end of the day, I want to ride a trend. I want to get on when the trend is healthy. I want to ride those winners until they don't work. And then when I get off when they stop working, or if they don't work immediately, I'm going to cut my losses pretty quick. In a good year, like last year, I'm going to have a healthy amount of winners, and I'm going to have a lot of winners that go up a lot. I'm going to be able to ride it. In a bad year, I would say like this year for me, it's been a bad year because my winning percentage is historically towards the low end, but the amount I'm losing is historically the same as it's been over 13 years. It's just I have more losers this year because I've been getting chopped up because the trend has been unfavorable for growth stocks in specific. So again, this is all part of how I manage risk. It is intricate, but at the end of the day, you have to have a strategy and a methodology to get you out of positions that aren't working and that aren't going to lead to a risk of ruin. And that's what we try and do. And there's two different betting styles. There's the martingale betting style or the anti-martingale betting style. And if you've ever been to Vegas with some friends or whatever it may be, and you're casually betting, most people, once they lose a bet, they'll double down the next bet.
Right.
Lose that bet, they'll double down again. Well, the risk of ruin is almost 100%, unless you have unlimited capital, but nobody has unlimited capital, right? Where what we do is the opposite. If we make a bet and we lose the next bet, we're going to reduce our bet size. If we lose again, the next bet, we're going to reduce our bet size, and so forth until we start making money. And when we press our bets is actually when we're trading the best.
Exactly.
So, historically, my biggest drawdowns are off of a peak because we have the most bets out. We have the most probably long exposure. And then that's when you get your historically, I've gotten my biggest drawdowns is off of pretty good runs in my equity curve.
Awesome. And I wanted to get into, I think, a problem that a lot of people have, which is focusing on the best of the best stocks for your methodology. And we've talked before, I know you run a pretty concentrated fund. So how do you identify the leaders in the market, the true market leaders, as well as identify kind of the leading groups and the overall trends underlying those leading groups, so you can focus on the best of the best opportunities for that particular market cycle? Sure.
Well, I will say MarketSmith is a great product, and they do a really good job of tracking industry groups and the leadership of which subgroups and industries are leading. So that in itself is a great product. What I do is I do most of my research for the given week on the weekend. What I do is I start from a top-down methodology where I'll go through all the major indices first, and I'll kind of rate them where I think they are in the trend. Whether we're in a strong uptrend, a strong downtrend, a choppy trading style, I'll assign some value to those indices, and then I'll drill down into sectors. And I'll look at what has traded well the last week, 3 weeks, 6 weeks, 3 months, 6 months, and I'll look at what's held up the best from a relative strength standpoint. And then we'll drill down into individual positions within each subsector. So it's really a top-down research process. And this takes me a few hours on the weekend to go through all of this. And it kind of gives me a visual representation of what is working, what isn't working in the market.
Mm-hmm.
A lot of what I do to identify leaders is through a screening process. And we run screens through, whether it's MarketSmith or I run TradeStation, I run some screens through there. And we're trying to identify individual characteristics that we're looking for. When it comes to individual positions, we're looking for, from a fundamental standpoint, we're looking for sales and earnings. I do have a fundamental background, so I sometimes I lean on that, and sometimes it gets me in trouble because I tend to miss or pass on some things that I don't love from a fundamental side, whereas it's price performance just acting so well,
Right.
I should be getting on it. So some of these preconceived notions still come up, and again, it's a constant battle and struggle of trying to take off that old fundamental analyst hat and just look at sometimes just price performance or why a certain subgroup is moving. I think biotechs are probably one of the biggest ones to. It's probably the hardest for me to analyze because most of them don't have earnings, and a lot of it is based on some binary event that is going to be massively favorable, unfavorable, dependent on an FDA ruling. But a lot of times they show up in a lot of just price screening or relative strength scans. So that's kind of the hardest thing from a fundamental standpoint, but there's certainly some characteristics I'm looking for on the fundamental side. Again, these are all just screened in our screening toolkit. And then on top of that, I would say it's probably a 60-40 mix. 60% is probably fundamental, 40% is probably some technical. So we're looking for stocks that are acting relatively strong against the general market, against other industries. And we constantly want to be looking at what is leading the market, and how do you determine what is leading? Well, at the end of the day, price is really the ultimate judge of what's leading, because things that are up the most in the last month should be the leaders. And that's how we filter all of our screening criteria. Just again, it's a hybrid of fundamental and technical criteria. And doing this as long as I have done it, I can do it in a fairly quickly and efficient way nowadays. Whereas, when I was first starting out, it took forever because I didn't know what I was looking for. But now I know exactly what I'm looking for, and I can identify what's leading the market fairly quickly. If you had to only run one screen to identify probably leadership, it'd probably be relative strength. But for what I look for in the criteria that gives me conviction, I have a tremendous amount of data and characteristics that I do look for.
Awesome. And I'm curious to hear kind of what your thoughts are on the current leaders in the market today. And maybe we could take a look at MarketSmith and go through some charts as well. I think that would be awesome.
Sure. So it just so happens I have Tesla up here. I think Tesla is probably one of the de facto growth leaders of this market. It had earnings last night. After hours, it sold off, and today it's rallying. I think Tesla is going to determine a lot of where growth stocks may go in the next 4 to 8 weeks, because I think it's the de facto growth leader of this market. So this is one I've been in. This is one I've probably made my most money in over the last 2 years. I think every growth leader probably has Tesla on their board.
Right.
And you can look, this is a daily chart. It's got your standard moving averages, 10, 20, 50, 200 day. It's got a big giant cup shaped base. If we back out to a weekly, it's got a really nice cup shaped base. What it hasn't done is created a handle.
Right.
You don't always have to create a handle. I mean, some of these things can rally without handles. But I would say, look at the last, 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks, 10, 11, 12, 13, 12 out of 13 weeks have been up from the bottom. That is some significant strength.
Right.
And granted, volume is below average, but it has increased a couple of these weeks. So these are the small clues that, I'm looking for.
Mm-hmm.
And it's had this massive prior up move over the last few years, and it's consolidated it fairly nicely.
Held the 200-day, held the 40-week.
Absolutely. Yeah. Absolutely. It's got a relative strength rate of 89. I mean, if you go and look at the fundamentals, I mean, earnings are going to be up 142%, 38%. Sales are exploding. So these are the things that we're looking for. Liquidity, I mean, it's plenty liquid. You can get in and out of this thing, no problem. For me, this is kind of the de facto growth stock leader. It's not it hasn't been the biggest price leader recently. There's certainly other ones, Upstart and maybe a firm that have had much bigger moves. But I think from an institutional quality type leadership, this is the de facto one. Let's go into Upstart. I'm sure this is familiar with a lot of your readers. I mean, look at this move.
Yeah, from the gap up on earnings.
This is also during a time when, quite frankly, a lot of growth stocks were chopping around.
Yeah,
they were within bases. They were, let's look at Shopify as an example. That's a prior leader, but look at what this has done during the time Upstart has gone straight up. It's gone nothing but kind of sideways, just chopped around in a big giant, maybe it's a base on base, whatever you want to call it. But at the end of the day, it hasn't really gone anywhere since February.
Right.
It's the same price it was in February. Whereas Upstart has done nothing but gone really straight up since its IPO. Massive accumulation. I mean, look at these big blue skyscraping bars, 99% relative strength rating. I mean, these are the things that we're looking for. I mean, earnings, 187%, sales, 32, 39, 90, 999%. I mean, explosion in sales. If you look at industry group rank, 3.
Right.
Now, this gets kind of lumped into the financials have actually turned around and have started to show some leadership. Your old line financials, regional banks, money center banks. So this whole industry is actually traded very strong over the last 3 or 4 months, and maybe that's coincides with the uptick in interest rates. Who knows? Maybe it is, maybe it isn't. But these are what we're looking for. We're trying to find the industries that are starting to move up towards the top quartile. So again, this has all the characteristics of the stuff we like, but quite frankly, I missed this whole move. I didn't make a single cent in Upstart because I wasn't willing to chase it once I missed probably this buy entry and then maybe something around here. I missed it. And I think a lesson that I learned the hard way is sometimes the best trade is to do nothing. Well, this certainly has had a monster price move. Chasing things that are extended typically leads to losses. And I have to realize that there's always going to be another trade, right? It's sometimes you have to let things go and be willing to miss them. And I hate missing them. And I hate, when I look back every year, there's always some of the biggest price movers. I missed it, but I do some post analysis. Why did I miss it? And I certainly know why I missed this, but I wasn't willing to chase it and give me an unfavorable risk reward trade that would probably easily had stopped me out once it went against me. Now, if I wait patiently, it potentially could give me another setup, and it did, and I was able to enter it in this area on a pullback.
Hmm.
So, you know, again, I think that's a fair lesson to a lot of especially new traders that are getting into this is you have to be willing to miss some moves, and you have to be patient and wait for a secondary setup.
And Ryan, with regards to this stock, a lot of people on Twitter especially are looking at how it's gone from 50 to 400 in an extremely short amount of time. And they're talking about price to sales ratios, all of that, PE ratios. What's kind of your response to that? Why did you feel like you should have taken a position in this, and why this is a leader in the market, given all those ratios?
Well, one thing I've learned of 20 plus years being in this business is that valuations in the short term don't ultimately matter.
Hmm.
In the long run, I think they do. And again, I come from an analytical background,
Right.
where that's what we really looked at was valuations. But in the short term, prices get irrational. And when you get a leader, they can go a lot further than you ever thought.
Yeah.
And your valuations are going to get extremely stretched. So I don't necessarily worry about valuations in the short term. Again, in the long term, I think they do matter. But I mean, some of the best stocks over the last decade and a half were expensive when they first broke out. And they went on to have 100, 200, 300,000% moves. Amazon was expensive for a decade. So, you know, the real growth leaders that have multi-year moves, I think are undervalued actually by the street. Because they don't see the potential upside or the game-changing nature of the business. But you know, I don't try and play that game. I don't try and predict where something's going to go over a 3 to 5 year time horizon, because that's not my time frame.
Hmm.
Again, historically, my time frame is a few weeks to maybe a year, 18 months. And in that shorter time frame, valuations can be extremely high and extremely stretched. So I don't worry as much about it. While I do look at it, because again, my old fundamental hat comes into play a lot. I look at something that's trading at a 400 P. It's a God, that's crazy, or a 100 times price to sales. It's just, it'll never grow into that. I've seen things go massively even further. And actually, one of the best examples is probably Zoom.
Yeah.
Last year, before Zoom broke out, I think it was trading at 80 times sales.
And 1,000 PE, I think 999
Yeah.
PE.
Yeah. And Zoom went on to have the biggest price move last year by far. It just was the perfect stock for the perfect environment. So, and I see that happen every year, over and over and over. If you're just fixated on valuation, you're going to miss a lot of moves. Now, again, there's a lot of smart investors that make a lot of money investing on valuation. That's just not what I do. You have to know yourself. And that's a much secondary indicator for me to a point where I try not to look at it. I try not to let it become a decision in the process when I'm looking at especially some of these high growth names that already are overvalued prior to breaking out.
Absolutely. And I want to hear your take on annual estimates and how important that is into your process, because looking at Upstart, obviously 871% growth for 2021, but then only kind of an add-on 11% the estimate revisions are up, but that doesn't seem like too much follow-on growth. So I'm curious, now we're getting to the end of the year, next year's estimates might be getting more into become more important. So how do you incorporate this into your analysis of companies and stocks?
So clearly, you know, again, earnings going to be up 171%. It's versus a very low number. So
right,
you're going to have that massive growth rate. So it's an easy comp, right?
Mm-hmm.
Next year becomes a harder comp. So while I prefer to see something, 20, 25, 30%, the bigger the growth, the better.
Right.
Again, those are street estimates. Those estimates could be wrong. I don't know. That's not what I do well. I'm not here to forecast what earnings are going to be. I look at current data, current price structure, and the way that Upstart is trading. It's telling me that the street still likes it and it's favorable.
Right.
Now, at the end of the day, from a sell regime, you know, my buy decisions, like we talked about, are probably 60-40 fundamental technical. My sell decisions are almost 100% technical. So if Upstart starts breaking down, if it starts breaking below the 10, the 20, the 50-day aggressively, I will sell it, ask questions later. I don't really necessarily care why it's selling off. I will just get out and I'll look for, you know, another entry, or I'll let it cool down. Certainly when things get so stretched to the upside or have massive price moves, they're super susceptible to snapping back. Most good uptrends in individual stocks will ride up a certain moving average, whether it's the 20 or 50-day over that, call it 18-month period where it has this massive price performance. But all good stocks will revisit a 50-day moving average. You know, stocks that are going to run for multi-year cycle are going to revisit the 50-day multiple times throughout their history. So you have to be willing to understand that. Now, a lot of times, once a stock breaks a 50-day moving average in massive volume and never recovers, it's probably done for that cycle. So it is, again, it's something that we watch. It's kind of the line in the sand for myself. Some people may use a longer term, whether it's a 200-day. I don't want to give stocks that much room to move unless I have a super low cost basis. So ultimately, if it breaks a 50-day in massive volume, I'm probably getting out and just I'll ask questions later, or I'll come back and revisit it if it rebases.
Mm-hmm. Perfect. And you mentioned AFRM. I think this is one of the strongest stocks in the market. This would definitely be worth taking a look at. Yeah, what are your thoughts on the price action, the story, and what really stands out to me is the huge volume increase over the past 2 months. You can see the moving average just has gone from like 4 million up to 15 million. It looks like that moving average. So yeah, what are your thoughts on AFRM?
Yeah, AFRM's another one I haven't made any money in. I've attempted to try this thing, but for whatever reason, I have gotten chopped up out of this. And, you know, sometimes it happens, unfortunately, but you are dead right. I mean, the amount of volume that has come into this, so this isn't, as Bill and he would say, your Aunt Susie buying, right? This is institutional money that's coming in. You know, AFRM, massive top line growth, 98, 57, 67, 71. Hasn't made any money, doesn't have any estimates to make any money. So you're pretty much buying this on revenue growth alone on top of massive relative strength. Like you said, I mean, look at the 50-day moving average come straight down and straight up.
Right. That's
just telling you the massive price appreciation really in the last 50 days. Industry rank of 49. This is good. It's in the finance industry. This is one I'm even more upset that I missed, because I actually use AFRM. I, much like many people over the pandemic, my wife and I, we bought a Peloton. And it had an option to use AFRM for essentially 0%. I could finance the bike, pay for it, and I almost wanted to just try and see what it was like. So that's why we did it. And basically every month they charge us $60-some, and after a few years, it's paid for. So I've actually been aware of AFRM prior to it being a public company, and I've completely messed it up. And again, it happens, and I have to be willing to accept there's mistakes and not chase it and put myself in a bad position to be stopped out with a bigger loss. So what I'm personally looking, you know, I attempted to try and get in this area and this area, and multiple times I got shaken out with small losses. And again, sometimes it takes you a few times to get an entry right. But now it's a little bit extended, and I'm probably going to be willing to just kind of wait. It's got earnings coming up. I'm going to hopefully wait. It gives me a secondary buy point. But again, this is exactly what I'm looking for. Big price appreciation, huge accumulation, big sales numbers. Again, in a perfect world, I'd love it to have earnings, but there's plenty of stocks that don't have earnings these days. And I think that, a lot of growth investors are buying, growth, revenue growth stories rather than earnings growth stories, because a lot of these companies are just plowing money back into their businesses instead of they're reinvesting it, really is what they're doing. So earnings, while is a huge indicator of past winners, it seems, nowadays that earnings aren't as much a
Necessity.
massive factor in huge winners, certainly. And again, I think that's what we talk about, how you have to adapt to the market environment. I think certainly that's been one of them for sure. Your historical leaders in the past, probably 2, 3, 4, 5 years, aren't ones that have the biggest earnings growth. It's probably the ones that have the biggest revenue growth, and they're taking market share in this winner take all mentality that we have.
100%. And I think it's really honest, and it's what real trading is like, that you're gonna miss a bunch of winners. You're gonna get stopped out right before it rips 20%. That's what happens. You just have to kind of try to be as focused as you can, and try to work yourself back in once it kind of presents another setup like you did with UPST. So 100%. What are some other kind of top leaders in your mind? And maybe I see some NVIDIA alerts going off. Maybe you can talk about the semiconductor space. AMD and NVIDIA have also been quite strong, especially the past few weeks.
Yeah, NVIDIA has been in again, a nice uptrend since, April, May. I think, in this space, it's probably the de facto leader. I mean, again, their chips are going into everything that is going to be the future. Whether it's AI or electric vehicles or energy storage. I mean, they're really on the forefront of the technological revolution that's probably going to just explode in the next 10 years. So again, this is on my leaderboard. I watch it every day, especially when it comes to semiconductors. AMD is not far behind. That's acted very well. But I think in the semiconductor space, I think NVIDIA is the de facto leader, and you always want to watch the top leaders in any industry. Again, you can make money certainly in some of the secondary stocks that are second or third place, but historically speaking, the leader in an industry group is the one you want to own and be in. And that's why, again, I follow NVIDIA. I keep it on my board. I actually own it. Again, industry ranks 7 out of 197. It's towards the top. I mean, look at the growth rate in revenue on a $500 billion market cap. That is just absolutely stunning and impressive. The fact that it's growing revenue at 68% last quarter, and then on top of that, it's got the earnings. And we talk about earnings estimates for 2022, like 66%, and then 2023 it's going to level off to 13. But NVIDIA historically over the years has, I think, been very conservative with their guidance. So and they've historically have beaten it and increased their guidance. So I'm not as concerned with that 13%. But it's really got everything that I look for. It's got earnings, it's got revenue. And again, this is for a company that's $500 billion. It's shocking, quite frankly. It just shows you how well of a run the company is. We take it out to a weekly. I mean, look at just this beautiful uptrend, way back in from 2015, 2018, and then it broke down. And NVIDIA went nowhere 2018, really through the pandemic lows. And this is the opportunity cost of sitting with something. There's other stocks that moved a lot more in this 2-year time frame than NVIDIA, while NVIDIA kind of went sideways. So, that's why I don't sit in things, or when a certain position breaks down, I'm willing to kind of get out of it and redeploy that capital into something that's working a little bit better. I always want my capital working for me. And a lot of times, these big winners will have dead periods. I mean, I think Tesla is a great example of that if you look at it on a long-term time frame. I mean, look at this.
Mm-hmm.
I mean, it did nothing for years and years and years and years before it exploded higher.
Yeah.
Same with over here. So there is an opportunity cost for sitting with something that isn't moving. There is something probably better that is moving somewhere else that I want to be always looking for what is leading and what is going to make probably the most money in a shorter time frame. It's a good lesson. And then back to, I wanted to kind of go back to an example of a prior trade that I did that Peloton was a massive leader last year.
Mm-hmm.
Obviously, it was I think Peloton and Zoom probably really were the two symbolic companies that rode the pandemic stay-at-home theme the best.
Right.
But from a trading perspective, I did not make a lot of money in Peloton. And again, I'm the one that thought Peloton was a fad, even though we ordered one. I thought it was a short term. These are some of the preconceived ideas that I have that sometimes hurt me because while I did think it was going to be a fad, Peloton had one of the greatest price appreciations last year.
Right.
But ultimately, I did make money in it by being patient and trading it later in the year, coming off this bounce off the 50-day. Albeit it was a smaller trade of mine, but I made money from here, up into this area while I miss the massive uptrend. So I think it's another example of being patient and being persistent and attempting to position myself in Peloton. I got chopped up a few times in here by buying and selling, buying and selling, buying and selling. So, there are some people that will buy it once or twice and never look at it again. I'm one, as long as I keep my position sizing small enough where my losses aren't big enough that I can continue to come back into it. And once it works, I can start pyramiding into it and get that bigger position size. And that's what I was able to do successfully here. Again, ultimately it was a smaller winner last year, but I did make money in it. And I think that's kind of a good example of again, being patient, getting rid of maybe some of your preconceived ideas of why something will or will not work. Because ultimately the market doesn't really care what I think, right? Price is going to tell me whether I'm right or wrong. And you learn these things every year and you talk to yourself, you say, don't think about certain things, whether it's this thing is too overvalued or, this may be a fad or may not be a fad. It doesn't ultimately matter. And price will be the ultimate, I think, measuring stick of whether something is going to work or not. And that's why at the end of the day, price is what ultimately pays, and why I watch it so vigorously. I focus on it, and why we track things every day. And like I said, it's a dynamic market. Prices are always constantly moving. They're always giving you a new sense of what is working and what isn't working.
Right. And this is also a good example of once it broke that 50-day, it kind of entered a longer term base that, yeah, it's also not my personality to sit through a long consolidation like that. Yeah. So yeah, I remember getting stopped out. I think it squatted that one day after making a big push. Let me actually use my Zoom tool so I can show you exactly what I'm talking about here. Right here, I think I bought it, and then the next day it squatted. I think I sold half and then got pushed out of the rest through the 50-day, and now it's just chopping down. Now the moving averages are curling down. So yeah, not one on my focus list. It still has to prove itself 100% like Tesla did, basically.
Funny. So I bought it in this area, bouncing off the 50-day, and then I ultimately sold my last piece as it broke through the 50-day. So similar stuff. Just it's funny that I do a weekly call with 3 other fund managers that trade similar styles, but we all have different results. And how could that be if we all are looking at the same stocks? Well, it comes down to execution. We all execute differently. Some of our time frames are differently. How we handle a stock or how we position it once we're in it is all different. So, there's a million ways to skin a cat, and even people that trade a very similar methodology can do things completely different from an execution style. So, one of the guys on the call is a longer term holder, likes to hold things through some basing. One is a lot shorter term. Will get out of something, as it breaks a 10-day. I'm kind of somewhere in the middle. So you have to, when we talk about trade your personality, it's so true. We all have the same philosophy and methodology at its foundation, but we all execute it so much differently, and that leads to different results. And that's why you'll never ever be able to trade successfully if you try and model yourself after someone 100%, because you're not them.
Mm-hmm.
Someone can certainly mentor you and give you and maybe expedite your learning curve. And I think what you do is a lot of that. But ultimately, everybody to their core has to figure out what works for them. And the only way to figure that out is to test multiple different strategies, ideas, and to do it in real time with real money. It's the only way to ultimately get that real feeling and sensation of the emotions attached. Looking at a historical chart, it's really easy to say, I should have bought Peloton here and I should have sold it here. That is so easy. You can't, you can go look at winter books and say, oh, I definitely would have bought it here. I definitely would have sold here. Well, it's a lot different in real time if you have a 1% position versus a 20% position.
Yeah.
And a 3% shake in a stock is a much big difference depending on your position size. And emotionally, those are the things you have to really go through individually to get that real world experience.
Absolutely. And yeah, that kind of fits with how I view paper trading a little bit. My kind of thought process for everybody who asks about paper trading, I think you should start out with a small amount of money, but trade real money, because it's a different feeling losing even just $1 in real money versus $1,000 in fake money on an Excel sheet. 100%.
I couldn't agree more. You'll never have the emotional attachment to fake money that you do with real money. I mean, there's no comparison.
Right. Absolutely. Okay. Are there any more leaders that you think would be worth talking over and going over? I know like DOCN is a price leader, but whatever you would like to talk about is good with me.
I think you have to look at the cybersecurity stocks. I have positions in CrowdStrike and Zscaler. Unfortunately, I don't have a position in Cloudflare, which seems to be the leader based on it just having just this monster move over the last month or 3 months, really. This is, from a fundamental standpoint, I think the number one thing that's not going away over probably the next decade is cybersecurity. I don't think IT departments are going to be cutting budgets from their cybersecurity marketing budget. I think they're only probably going to increase it.
Yeah.
And I think that's playing out in a lot of these stocks, whether, again, it's Cloudflare, CrowdStrike, Zscaler, even Palo Alto Networks. There's a whole host of them that are having just outperformance, and there's an outperformance for a reason. Again, all of these have just giant sales growth, 50% plus. And these are big market cap companies. But I certainly think this is an area that I want to be focused in on. I think it has the theme that I'm looking for. I think the fundamentals of the whole space are not only favorable now, but I think favorable for the next, I wouldn't say decade, but from what I'm concerned about, the next few years for sure. And this is, again, Cloudflare, I'm not in, and I'm in some of the other ones. But I have to be willing. I was in Cloudflare previously last year. I never got back in. I have to be willing to be patient. I may have missed it. I don't know. But I think this is definitely one of the areas that I'm focused in on from a thematic and growth standpoint for sure.
And so we've talked about a few themes, kind of like fintech with UPST, semiconductors, NVIDIA, AMD, and now cybersecurity. Are there any other big themes that you're kind of watching to see what kind of IPOs come out, what kind of true market leaders could emerge? Yeah, I guess overall, what kind of themes are you watching?
Well, I do believe that, and this goes to, most of what I do is research.
Yeah.
I spend very little time on actually trading. I I spend most of my days reading and just reading a lot of um, market-based research on sectors and themes, on individual companies, doing a lot of statistical work on, I do believe that the market may not repeat, but it rhymes. And we look at a
Hmm.
lot of historical patterns, a lot of pattern recognition. Um, but in the real macro view, again, I don't trade in decades.
Yeah.
My time frame, like we've talked about, is weeks to 18 months. But I think having a view of the big macro picture, I think kind of helps shape my thesis and why I'm excited about maybe cybersecurity or maybe Tesla. So what I do believe, I think we're in this technological revolution that is here to stay. It's the next 10 years, I think, we're going to see such massive advancements in technology that there's going to be just such massive winners. At the same time, there's going to be massive losers. And we're kind of in this environment where it's the winner take all, where you're going to have this probably the market's going to be dominated by a handful of massive technological winners that are going to have huge market caps. We already know about the $1 trillion market caps in Microsoft and Amazon and Facebook, whatever. They have such a massive weight in the S&P, but I think over the next probably decade, you're going to have a handful of stocks that are going to be the next $1 trillion market caps. And what are they? What are the areas that they're focused in on? And that's kind of what I look for. What are the next up and coming growth areas to be served? Whether it's, I think energy, healthcare, these are just big macro themes that are going to be huge. And there's going to be some huge winners in it. And some of them we may not even know right now. But I think if you look at certain companies now that are positioned extremely well for those really macro trends, I think you have to put NVIDIA in it and a Tesla. I mean, Tesla checks almost all the boxes, from energy storage to solar to certainly electrification of everything is probably a massive theme. The whole ESG thing of getting away from fossil fuels is real. I think there's going to be certainly some consequences of that, some unintended, but it's definitely here, and I think it's probably here to stay. So I do a tremendous amount of reading on just big macro themes, and then I try and drill it down into the micro and say, what are going to be the potential winners within those spaces. Again, I'm not trying to forecast winners for the next decade. I'm just trying to think what is in a hot area thematic wise in the short term that I can exploit its trend on the upside. And that's really what I do on a day-to-day basis. Anyone that gets into this business thinking that you're going to, I tend to tell people what I do is actually very boring. You tell somebody you're a hedge fund manager, like, oh, that must be exciting. Well, I mean, it's stressful. I'll tell you that. Yeah. But the least amount of my time is spent actually physically trading and making trades.
Right.
I certainly have, time frames where I'm a little bit more busy than others. But I've already planned out most of my trades in advance the weekend before, or as the morning evolves. I kind of know what I'm going to be doing. And then I spend the rest of the time just executing that plan. And then that's probably 5% of my time. The other 95% of the time is just doing research, trying to find the next Cloudflare, or trying to find the next NVIDIA, or trying to find the next upstart that can have a wild outperformance in a 3, 6, 9 month time horizon. So that's what I am focused on. And I would encourage, especially new people, new traders that are getting into this, you have to really enjoy it.
Yeah.
Because if you don't, you won't spend the hours upon hours that other people do researching and reading and being curious about what the future may hold. And that's why I love this market, because you never know what your next trade could be your biggest winner. Again, I had my biggest winner ever last year after, trading my fund for 13 years. I had my biggest individual winner last year. So it's what gets me up in the morning, what excites me. And it's not without certainly its pitfalls. I think the hardest thing to do in this business is have staying power.
Yeah.
And there are going to be times that you go through that you just feel sick to your stomach and you almost feel like quitting. And it's easy to quit. But I think the people that survive in this market have supreme confidence in themselves and their strategy, and they're willing to go through and get through those down times. I mean, I've certainly had them, and I'm going to have them again. But as long as I have confidence in myself and I have a sound strategy and I have, again, historical data that backs it up, I believe in myself that I can come out of it. And just when it looks, the worst at your lowest is sometimes right before you're going to have your best move. And I'm proof to that for sure.
Awesome. No, that's great. And I want to ask you if there's if there are any IPOs that you're watching in particular at this moment, and also whether you kind of trade that first advance before maybe the longer term base. For instance, I'm kind of watching Bros at the moment. I do have a position in that that's shown a lot of accumulation up the right hand side of that IPO base.
Yeah, so I certainly do follow IPOs, and a hat tip to Eve Bobach and Eric Kroll and Kathy Donnelly, who are all friends of mine and who wrote a fantastic book on IPO trading, and I would say they have mastered it for sure. I tend to wait a little bit longer than probably they have written about in their book. That's just kind of what has worked for me or what I'm more comfortable with. I'd rather have a little bit more price history to trade something. But we have seen some absolutely explosive moves out of IPOs after just a few days of trading. I mean, one of probably the best examples is if you go back and look at Google.
Yeah.
After a couple of weeks to a month of trading, it just exploded out of a very short-term base. So I never say never. I just historically I prefer a little bit more price history. Bros, I've certainly looked at. The one thing about Bros, I do like to. I think another hat tip to Eve Bobach. She does something very well where she likes to test products. Especially something that is very tangible and easy to test, whether it's a restaurant or a new product. Bros is a West Coast based, Midwest to West Coast based coffee shop that I've never been in one. So I'm really not that familiar with it. What I do like about it certainly is the growth metrics of it. It is a newer issue, which again, I do like. I like looking for things at newer issues within the last 2 years.
Yeah.
So something that's been trading a few days or a few weeks or a few months, I historically don't trade them that soon. And I've certainly missed this as it's run from 45 to 65. But I think if this sets up and gives me a secondary buy point, I certainly will look at it. It's on my list. I followed it, but I haven't traded it, no.
Gotcha. So you're more focused on like a stock in its maturation cycle, like Unity Software, ABB, Roblox, which has had that kind of first base. Gotcha.
Absolutely.
And Snowflake as well. Snowflake.
Absolutely. And all of those that you said are on my watch list and I'm watching. I'm really interested in Roadblocks, really just for the simple fact that I have 4 kids and almost every single one of them has played it at some point in their life. And I love the story behind it. I love the growth rate. I think this at some point, again, it remains in this kind of like choppy, potentially first stage base. I'm watching it. And again, Unity. I think we're all familiar with probably the metaverse. I think from a macro theme, the metaverse is going to be a massive, massive winner. And space and try and finding the biggest winners of them. And I think Unity is going to be a big player in that. So that's another one that I am watching. I don't own. A lot of these are just shaping out, kind of their maybe potentially first stage bases.
Right.
And I think earnings season is going to dictate a lot for the next couple months. The fact that Tesla's reacting favorably today, I think helps.
Yeah.
But in the next 4 weeks, we're going to have a tremendous amount of new information, and that's in earnings. And it's not necessarily the earnings that I'm concerned about; it's the reaction to the earnings that I'm more concerned about. And that's what I'm going to be basically watching over the next month: is how are individual securities reacting to earnings. Again, I think Tesla having a upside reversal after gapping down is a good sign. That's just one stock in a universe of hundreds of growth stocks that I'm watching. But overall, I want to see, is this a market that's going to be rewarding earnings, or is it a market that's going to be selling off earnings? And it's to be determined. I think we've only had really 2 right now that I follow, Netflix and Tesla, and both of them have kind of been muted. Tesla is having a little bit of an upside today. Netflix has been a little bit muted. So that's going to be the tell for me. How are these high growth stocks reacting to this new information of earnings, and time will tell.
Yeah, I remember talking with Jim Ropel, who I know and it kind of flipped a switch here when he said, like, earnings reactions kind of give you a sense of the risk appetite of institutions, whether they're willing to buy up these high growth stocks, or if even on good reports they sell it off. That's information about the current market environment conditions. So yeah, I think that's a very key point. Yeah.
And quite frankly, for what I do and growth specific, it hasn't been that way since the first quarter. So I think, January, February this year, you were being rewarded by holding growth stocks, and earnings were gapping up. And then mid-February, it just came crashing down.
Right.
Both got sold with the rise in rates. The old economy, the more value-centric stocks were what took the leadership. And growth has really kind of been in this bear market since. If you want to just look at a proxy, the ARK funds are still well below highs made back in February. So that's, I will say, the character of the market has changed for the first time for me in the last few weeks, where growth has started to outperform, even in the face of rising rates, which has been the opposite of the past 6 months. So I've probably been more aggressive in the past few weeks than I have in the past 6 months. So that goes back to, you have to know what market cycle you're in, and you have to adapt to those market conditions. In a choppy market, I'm not going to be super aggressive. I'm not going to be buying a whole lot of breakouts because I know a lot of them get faded. In an aggressive uptrend, you can buy those breakouts. You can be aggressive. You can position size bigger. You can be more concentrated. You can have more capital deployed. I'm starting to get that feeling. Whether that works out, I don't know, but I'm putting more trades on and risking more capital because I'm being rewarded over the last few weeks, where I would say the last 6 months, it was just nothing but fits and starts.
Right.
And what I did to adapt to that is I drastically reduced my position sizing, how much capital I was willing to put to work, and I just kind of played small ball. And I still got chopped up, but I kind of reduced the amount of choppiness by playing smaller. And I think that is part of the process of knowing where you are in the market environment and knowing how to adapt to each one.
100%. And Ryan, this has been awesome. I really enjoyed talking with you. I always like to end it with kind of one last question. What kind of advice do you have for newer traders who just started in the past years and are looking for a style, or they've started to learn CanSlim or some other method, but are having difficulties really committing and getting to profitability?
Well, I think we talked about a lot of ideas and lessons for new traders. I would say first, be curious. Don't stick to just one trading methodology idea. You have to explore them all, and ultimately you have to find what works for your personality. That's the number one thing. And then start small. Don't paper trade like we talked about. Start, even if it's a couple $100. Start trading with some small amount. That's the only real way you're going to get real life experience and feedback
Yeah.
to how it feels to make and lose money, and whether you're never going to be able to stick to a methodology going through your first bad period if you don't believe it and you don't understand it. So you have to get educated, you have to be curious, and you have to put capital to work. I would definitely start small. Once you get some confidence, then you can increase your size. Until then, stay small, be curious, and don't ever stop learning.
That's a great point. Great advice. Ryan, thanks again for taking your time and doing this interview with me. I've really enjoyed it. For anybody who wants to kind of reach out to you or if they have any questions, where can they do that? Is email best, Twitter? What's kind of your preference?
I am on Twitter. I don't have a huge active presence. I'm too busy running a firm and a
Yeah.
fund and a family, but I am on Twitter at Worch Capital. You can check me out. My website has some information on worchcapital.com. Reach me there, and I love to talk to anybody that's again, I love talking markets because I have such a strong passion and desire for this that I'm willing to really talk to anybody.
Awesome. And I think that passion 100% shines through. So Ryan, thanks again. For everybody watching, I hope you guys enjoyed this. If you did, go ahead and leave a like down below and subscribe for more great interviews like with Ryan here. And we'll see you guys in future videos. Thanks.